Edutrainment Workshops, the insurance industry's leading education and training platform, presents Life Insurance, the entry-level series, the products, the underwriting, and the planning applications to position your practice as the premier provider of insurance products in your community. Get on board, get on track, get to where you're going. And now, your Edutrainer, national insurance columnist, Steve Savant.
Well, welcome everyone. I'm Steve Savant, your Edutrainer and coach for our Edutrainment workshops and our entry-level introduction into life insurance, our life insurance series. And I have to say, we've been all this week doing our introduction into variable universal life, and we're getting a lot of email traffic because people are really kind of confused. What's my licensing? What can I talk about? Again, every state has their own regulation, and just a heads up, make sure that if you're not FINRA licensed and you're talking about anything security-wise, you may be opening yourself up to liability. So, depending upon your case-by-case basis or state-by-state basis, just be aware. Now, of course, we're using Lincoln Benefit Life's proposal system because we believe it's a great tutorial. If you haven't downloaded it yet, just hop out to their site, www.lblsales.com/ETW. That's lblsales.com/ETW. And as soon as you get to the front page of their site, hit Eclipse Software Installer, hit Run Installer, and it'll download the software for you. And I'm telling you, this will really help you. You can go page by page with us as we're going through some of these. Every time we use their illustration system, we think it's a great learning curve and it'll really expedite your understanding. A lot better to do hands-on. Now, another issue is down at the bottom of your screen, you can see that email address, and it's also in the search engine optimization description page where you can cut and paste it out. We want you to go to that. It's awful long, that's why I didn't want to really say it. And on that page, you'll see an inventory that shows so many support items that are really great for you, especially if you're coming into our business the first time. And one of the ones that we love is called the Facts of Your Life booklet. It's an easy booklet to use. It either comes in hard copy or email attached. We'll send it to you, or you can go right out to the site and download it. We think this is an excellent data collection tool for your client. And what I really like is that it really covers all kinds of things, including who would be the pallbearers, backup pallbearers. I mean, really things that I would have never thought about. But the real thing I like on this page is the prospecting letters and the prospecting postcards. If you're saying, gee, I need to get into marketing, how do I talk to retail clients? How do I write about it? Well, why write about it when it's already been done for you? Heads up, if you're a FINRA registered rep, you're going to need to run these through. Even though they're compliance from all states' point of view, each broker-dealer needs to do their own review of this before you use any of these, but they'll be really great tools that you can use. Most BDs are pretty appreciative of how this language is, and I don't think you're going to really have any problem. But again, if you're FINRA registered rep, you're going to have that approved. And if you're in a regular life insurance agency that has compliance on outbound communication with clients, you're also going to have it approved as well. You wanted to get it approved so that you don't get reproved. Okay. Now I'm on our site, www.brokersalliance.com, and this is our homepage. And if you ever get behind in any of our classes and say, Steve, I don't know, I need to get back, I don't remember you talking about that, it's all in our tutorials, all in our archives, all on our front page. You just come to our homepage, www.brokersalliance.com. As soon as you come to it, there's a big red button, On Demand Videos. It'll put you right in. It'll either be the Business Insurance Zone, or you'll see Edutrainment Workshops, or you'll see my weekend show, Welcome to the Weekend with Steve Savant. All right, now today I want to go back into the illustration system. Hopefully you've downloaded it at www.lblsales.com/ETW. And I'm on page 16 of yesterday's proposal. And if you say, Steve, I'd like to get these proposals to kind of get an idea, I'd be happy to send it to you. Just write me, thebiz@brokersalliance.com, and I'll send it to you right away. Now, we're on the expense charges summary. People always ask me, because I do so much, we've done a lot with the CPA community over my career, in bringing life insurance to them and showing them and teaching them. I've taught many classes there. We always recommend that you show this page. This is one of the most endearing pages to a CPA, a tax attorney, or a trust officer, the declaration of the expense loads inside the contract. And I like to show it because it shows good faith, and we show the breakout on everything that's happening with the premiums that we're putting in. Now, as an example, year one, in this contract, we're putting in $3,912. And I noticed that the premium expense charge is $205. And they have the M&E charge, the mortality and expense risk, at 17.42. And the admin charge, which generally has the policy fee and their admin charges in it, and the cost of insurance, in this case, because of the death benefit, $1,184. And you'll notice every year the cost of insurance is going up. This is like having an annual renewable term inside a universal life chassis. Every year, every month, it's going to stay pretty static for that year. Then the next year, it'll start bumping up. We're doing it annually here just to save ourselves a lot of pages. So when you see this cost of insurance, $1,184, second year, $1,482, third year, $1,737, and so forth. I mean, 20 years out, you're at $4,705. So what you're trying to do here is those are the internal charges based on current company practice that have to be paid. So they're going to come out, and what's going to happen is I'm going to put my premium on the table, give it to the company, $39.12, and the premium expense charge, the M&E risk charge, the admin charge, and the cost of insurance is going to come out first. Once I've taken out my expense loads, then I'm going to credit my gross investment earnings, and then I'm going to be looking at my end-of-year policy values. Remember, that's the end-of-year policy value, not the end-of-year surrender cash value. Big deal difference, especially in the early years. Now, if you want to kind of get an idea, and I do, I always want to say, well, what's the number here? I'm looking at basic numbers of expense loads. And now I'm getting out into the later years. Notice that everything isn't static on the premium charge, and the admin charge actually goes down, and many contracts are like this. But then you start to see cost of insurance, all of a sudden that disappeared. What happened here? They actually did a few things in here where when you get past a certain age or a certain year period, that they're not charging for it in this scenario. But I noticed that the M&E risk charge keeps going up, and that's why you want to look at the actual contract. Why did this disappear? Why do certain companies go all the way out? You want to look at the age, how age the client is, what year it is, so that you can determine, is the expense loads on this contract, are they in the game or not? And here's what I like. A couple of days ago when we talked about our spreadsheet grids, I can take all those carriers and I can print only these pages based on the same information, input information, and I can actually calculate, because really you don't know what you're buying. You don't know what the S&P is going to do on an index. You don't know what a variable account's going to do with all of its moving parts and all the asset allocation sub-accounts that you're using. But we have a pretty good idea what the expense loads are going to be like. So if I see a contract and everybody's using similar sub-accounts and similar funds, I think I'm going to start looking at which contract gives me the least amount of cost. And that's why I like to print this page and do side-by-side comparisons. To me, that's a great way of measurement. I don't know what the equities will do, but I pretty much know what my expenses are going to be. And sometimes the expense load from carrier to carrier, as we showed you 2 days ago, 3 days ago, whatever it was, the grids themselves will show you there's anywhere between 100 and 150 spread on a lot of these carriers on your internal rate of return. It'll be less because their expense loads are so much higher. So you really want to do your due diligence. And to me, a due care approach is printing the expense pages. So when you're looking at 3 or 4 different carriers, and we do this all the time here, we like to look at it all and then measure and say, especially if it's income, this is the carrier we think has very good expense charges. They've really managed this quite well. Now I want to go back on page 14 for a second. And I want to look at something called the internal rate of return page. I used to remember how we used to do index costs for insurance, but it was too confusing to the public. But this isn't confusing to the public. Internal rate of return. Now this is more of a death benefit play, so the cash value rate of return, even though we have cash in here, we've been spending more than we're taking in, so there's not going to be any internal rate of return on the cash values. If this was an income play and I saw nothing in here, then I don't want it. This contract's been done wrong. So what I'm looking at here though is, think about this. In the event that the client actually died in the first year of the contract, he would have put down $39.12 for premium and paid, and his return would be 6,289% rate of return, which is unbelievable. Now about 10 years into the contract, we're measuring still because this is a death benefit play, not a cash play. So notice this, in the 10th year, if death would occur, there'd be a 32% rate of return on money. And remember, if this is set up correctly, the client may have also received this benefit absolutely tax-free. So when I'm looking at this, I notice that I'm starting to get some cash value numbers now, as you can see in our later years, year 21. And again, not that we're looking at this so much, but I'm looking at the internal rate of return. That's why I suggest to you, if I'm really doing this for death benefit, you may want to start looking at your idea. Should I look at VUL for a death benefit scenario? Because I might be able to get better leverage. And when I use the internal rate of return leverage, I'm going to be looking at that column based on what I think the client's actual life expectancy is. Now, if our client's 58 and I'm thinking that they have 20 years, 88 on a standard platform, then I'm going to be looking at that rate of return. That's not a bad one, but I'd still run, if it was death benefit, I'd still run a guaranteed UL against it, or maybe even a whole life contract to see which one's going to give me my best rate of return death benefit. If this was income, we would be buying the least amount of death benefit we could. We'd also be selecting the best death benefit option that gave us the best numbers, and we'd also be selecting the best insured in the family. Not necessarily again for coverage, but for supplemental income. So it could be true that in my case, my wife's cost of insurance is less than mine. My eldest daughter is less than hers. So you look in there and you're doing it for income, you want to make sure who among your immediate family would I look at this from an income play if I'm doing it for supplemental income, and I would use that person who has the least amount of cost of insurance. Especially in husband and wife relationships, generally, the wife is going to have the lower number if they're the same age, and if they have similar health considerations. Cost of insurance is a big one, and I'm going to be looking at the internal rate of return in here. Now, we already know that because of the internal rate of return, we already know our cost for the fund itself is 0.67. And then I showed you the previous costs on the expense pages. So I have to take those all in. I have to take that off the top of my gross. What's my net number after they do all the expense loads? And remember, just a little side note, we're going to get into this next week on indexing. Many people really frame indexing that you cannot lose money. Well, you cannot lose money from a crediting interest account point of view. But every day, for example, in the 2001, 2, and 3 S&P years, those were 3 loser years. You still have the bills to pay. All the expense loads in these contracts still have to be paid. So every year, between 2.5 to 300 basis points were being taken out in 2001, 2002, 2003. You actually experienced a 2.5 to 3% loss. And you say, but Steve, how can that be true? Well, next week we're going to talk about indexing and say, yes, your indexing credit account didn't lose any money because that's what they do. They use those options in their bond accounts. We'll talk about all that next week. But really, you still have expense loads to pay. So I look at VUL, you have to be into a long haul mentality. You have to have a deep appreciation for tax advantages. Now, on second to die on some of these contracts, they built these for such a long haul issue because you have 2 lives on one contract. In a couple weeks, we're going to talk about survivorship. And sometimes VUL can be very well played, or especially when the carrier allows you to put in some guarantees. It could be a way to go, especially if you thought that your assets or your estate were going to grow at a rate that was greater than fixed rates or even indexed rates. So you may want to consider that as well. One of the things I like to look at is the internal rate of return accumulation page up to age 65 if it's income, and I want to see what the income is at their LE or their life expectancy, and what did they really blow through the numbers? And I have a super preferred female who I think is going to live well into their 90s, maybe even age 100. I want to look at the internal rate of return on cash to see if this is a good deal. If this is done correctly for an income or a supplemental income scenario, especially for retirement, this can be an excellent tool. And remember, heads up, the strategic withdrawals to basis in the appropriate years and policy loans of gain on these contracts will never ever affect your Social Security benefit as long as the contract stays in force and you do what we tell you to do in the order that we suggest. So when I'm looking at this, not only am I getting tax-free income supplement off of variable universal life and having access to the market, but I also am going to be able to not affect my Social Security when I take policy loans of gain and appropriate withdrawals to basis in the right years that I have to take it out. This is an excellent tool if you know how to do internal rate of return and you know the expense loads of the policy, and you're able to put that together and give a great option for your client.
This has been an Edutrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, and sponsored by Lincoln Benefit Life. an Allstate company.